Hello and welcome to our webinar. We're going to give everyone a few minutes to log in. Looks like a lot of people are coming in. Hello and welcome to our webinar. We'll be starting shortly. Hello and welcome to our webinar. We're excited to talk to you today about elevating your earnings and share some expert strategies for waterfall distributions and deal structuring. Before we get started though, just a little background on us and an intro to my colleagues. We are CoverC. We are the first real estate syndication platform where banking meets investment management. And my colleagues today, Gal Miller spent 15 years building products in fintech. Notably, he led a team which built a digital neobank Pepper, taking the product all the way from ideation to execution. At CoverC, he leads our product and technology teams, and he's the mastermind behind our uniquely transparent and accurate waterfall engines. And Colin Rao built his career in real estate technology sales. He's worked for market leaders, LoopNet and CoStar. Colin leads our CoverC US sales team, where he has doubled our US customer count this year alone, bringing our total GP customer count in the hundreds. Colin's expertise is in designing solutions for our customers when they have very specific use cases. And then myself, hi, I'm Tara Lavelle. I lead marketing for CoverC. I spent the last decade in fintech, leading marketing for Cardinal Commerce, which I joined at an early stage and went all the way through our acquisition to Visa. From a logistics perspective, please use the chat to ask questions while we're going, and we'll cover them at the end. Gal is going to start off with some definitions so that we can all be on the same page and talk about different kinds of structures and waterfall distributions. Next, he'll walk through some case studies of different deal structures. And being that real estate can be pretty complex, he'll show some common mistakes that can happen when you're building different deal structures. After, Colin will walk through some different structures on the actual CoverC platform for you. And then finally, we'll wrap up with questions. Gal, take it away.
Thank you, Tara. Hi, everyone. Happy to be here. Let's start. So a waterfall distributions allows us to distribute funds differently at each step of the deal in a way that at each step, each phase, we distribute the funds until we complete that phase, and then we can go to the next hurdle or phase in the waterfall, and that's why we all know it's called a waterfall. Now let's look at the most common waterfall structure that we've seen. Commonly, the waterfall will start with a return of capital hurdle that is going to go 100% to the investor until we return the investment funds to the investors, and a preferred return that I like to call the minimal profit if everything goes well, that is typically between 6 and 9%. Also depends on the Fed interest at that point to make the deal attractive. And this hurdle also goes only to the investors. Then once we've returned 100% of the capital to the investors and pay the preferred, now it's time to split the distributions between the investors and the GP according to the deal agreement. At this case, we'll look on an 80-20 split. So to level our gains, our GPs, with the funds already distributed to the investors as part of the preferred return, we need a catch-up hurdle, also called a trench, that will go 100% to the GP until the distributions are leveled at an 80-20 point. Now, there is also another option. It's called a semi-catch-up, where the GP is not receiving 100% of the distribution in this step, but only 50%. It's less attractive for the GP, but it depends on the leverage that the GP has over the LP when structuring the deal, and how much the GP wants to make the deal attractive to the investors. The last hurdle would be a profit hurdle according to the level the catch-up brought us to. So it will be 80-20 at this example. Now, we can also add additional hurdles to the waterfall, and I think this is in the GP's interest. So if the deal performs really well, it's fair that the GP will receive a higher cut of the distributions. So in this example, we have a catch-up hurdle that is 80-20, followed by a profit hurdle that is also 80-20. But once we cross a 14% IRR rate, then we add another catch-up hurdle for 70-30 and a profit of 70-30. Another example of a waterfall structure that can be used, and mostly used for deals that are held indefinitely or for several decades, is based more on equity multiple hurdles. So in this example, you can see a preferred return optional hurdle you can include or not in the deal that goes to the investors and makes the deal more attractive, promising some level of revenues during the deal time, followed by two equity multiple dependent hurdles. The first one is up to 1.5 x of the investor's investment. And at this point, the investors will receive 70% of the distributions, while the GP will receive 30%. Then, after 1.5% of equity multiple is achieved, the second hurdle will start being effective, and it will be a 50-50 split. And it makes sense. The deal performs well. The risk for the investor is reduced. So it makes sense to get a better cut for the GP who did a good job. Now let's look at some case studies. We are here on the CoverC GP platform. We're going to run a waterfall on a Q4 23. I'm going to run a waterfall for 5 million. It's only once needs to be configured in the platform, and then it took 1 second to calculate. We can see how much each investor needs to receive. And currently there's only one hurdle. It's the return of capital, because 5 million was not enough to cross this hurdle. So let's make it more interesting and distribute 25 million. Now we see that the investors have more hurdles that they've crossed. We've seen the return of capital, the preferred. We can see that the preferred has 0 promote for the GP. As we said, it's going 100% to the investors. But on the catch-up, and this one is a semi-catch-up example, we can see that the gross distribution is 13K. The investor gets 6 eventually, because half of the hurdle goes to GP promote, hence a semi-catch-up. Now, let's look at the calculation and the file. We can see the standard waterfall structure, starting with a return of capital, then a preferred return, and then a semi-catch-up. That is, both the GP and the LP are paid, and then an 80-20 split to the GP and the LP. And we can also see that the control shows that the split is exactly as we planned. Now, let's look at another example. We'd look at another deal. with a different structure. Run again a Q4 23 distribution on 25 million. Again, it's pre-configured, takes up to a minute to calculate. Here we already have the results and we can see the hurdles, but let's look at the file. So here, we'll see something that's similar to the previous waterfall, but a bit different. So the first two hurdles are exactly the same. We've seen them in the previous example. Here, the catch-up and profit also looks the same, but there are two major differences. One, that the catch-up is not a semi-catch-up, it's a full catch-up. So 100% of the distributions go to the GP in this hurdle. And the profit is only splitting 80-20 up to a 14% IRR rate. Above that, we'll have another catch-up to 70-30, again, a full catch-up, and a 70-30 profit. So since this deal performed well, the distributions you can see here in the control are 70% to the LP and 30% to the GP. Much better deal for the GP since we added those two additional hurdles. Last example, and then we're going to go over common mistakes. We're going to go to another deal, Q4, run a 25 million distribution. This deal is based on equity multiple. So the waterfall structure looks a little bit different. We can see that here we had a preferred return of 7% that's paid 100% to the investor. Then up to 1.5 equity multiple, we're paying 70% to the LP and 30% to the GP for promote. And then the rest of it, after we cross that, is split evenly between the GP and the LP. For the next part, we're going to go over some lessons learned, mistakes that we've seen implementing dozens of waterfall structures with our customers. The first example is the most common that we've seen. Commonly, deals start where GPs want to only meet the preferred payments in the first several years. And that's okay if all the investors have the same preferred rate in their deal. But most common than not, you have a few investors that are either strategic investors who invested more or joined early on and took more risk. And they have, for example, 8 or 9% preferred. And then we can't just meet the preferred payments. We would need to pay according to the prorated distribution, and some investors will get some of their capital back. And I'll show an example. Let's take as an example a first distribution of $2.4 million. We have two LPs. They both invested $10 million, and they both have the same ownership in the deal. The difference is LP1 have 7% preferred rate, while LP2 have 8% preferred rate. The gross amount must be prorated between them according to their ownership. So the 2.4 million, third of the deal, 33% ownership, both of them are receiving 800K. It differs on how we are considering each dollar of this distribution. So for LP number one, to meet the preferred payment, we need 700K. So we have 100K left from the 800K gross amount. And this will go towards a return of capital hurdle and would leave this investor with 9.9 million capital account after this distribution. While LP number 2 needs 800,000 to meet the preferred payment, which leaves $0 for the return of capital, and the capital account is the same, did not change. Now, GPs sometimes just want to pay 700 plus 800, but if you paid just that, it would be split between those two investors because they have the same ownership in the deal, so you cannot pay them differently in the gross payment. The second type of mistake that we've seen that can actually cause some losing some revenues is, since it's difficult to calculate 7% preferred without a platform, a lot of GPs, what they do is they take the annual payment and split it by 4 to pay for each quarter. Now, this would, for a 120K a year example, this would look like that. We'll pay 30K each quarter for one investor. And if you look at 30 investors, then it's going to be 900K for each distribution. But if we look at an actual 7% preferred calculation, then it looks differently. You pay less in the beginning of the year, and then the payment goes higher towards the end of the year. So you pay an additional, in this example, an additional $50,000 at the beginning, in the first half of the year, that you didn't need to pay until the second half, and most of them until Q4. And if you realize the deal at the mid of the year, then you might lose these funds completely because it will not balance toward the end of the year. So it's critical to calculate it correctly and not just divide it by 4 or 12 or something like that. The last mistake is not building the waterfall distribution file while drafting your contract, sometimes causing some GPs not to be 100% familiar with how their deal is actually working. We've met a few GPs that only started paying preferred on the second year of the deal and did not know that they need to pay accrued from the first day of the deal. They thought the first year is not going to be included. We've opened the contract with them and we've seen internal rate of return of 7%, but their lawyers even emphasized in the aggregate. So it's important to go over this structure, implement it as early as possible, and try to not miss stuff like that, if the GP noticed in the beginning could have maybe be changed. If you have any questions, we'll be happy to answer in the end or follow up. I'll now transfer to Colin that will show you more about how we can automate waterfalls.
Okay. Thank you, Gal. I'll go ahead and steal the screen share here. Okay, perfect. All right, well, I think that was a pretty good breakdown of some of what we can expect to see in really, I guess, a wide variety of different potential waterfall structures that exist out there. And there are definitely a lot of variations. And even for these, which are relatively straightforward, we saw there's still different pitfalls you can fall into if you're not careful, which is why it's important to really iron out these details in the beginning. To answer your question, Aran, which I just saw pop up, yeah, we will be sending a copy of this recording after the call. But of course, once we've got all the details of our waterfall squared away, it's just as important for us to set up a system to actually be able to execute on the plan that we've created and to ensure that moving forward, our calculations are accurate. We're paying our investors on time, could be quarterly, monthly, semi-annually. Maybe you're doing a refi in year 3. You've got a separate capital return structure for those kind of events. We want to ensure that we're handling accruals appropriately, and we want to be able to track our historical distributions in a way that is clear and transparent and will allow us to reference them later on if the need arises. And also, it shouldn't be something where you feel like you have to scramble to get those things done when the time comes. So what I'm going to walk through here is the system that we've created for handling these waterfalls. And I'm going to go through real time what it looks like to create and run a distribution and pay out our investors within our platform. And then I'm going to back up and I'm going to go into, we saw earlier that we have the ability, Gal showed us, to download the actual calculations and to look at them and to basically see our proof of work. So we're going to dig into that as well. What we're looking at right now would be an example of one of my projects in our system. We can see that I've got an overview of all of my investors. Ideally, within the cover sheet system, our investors have actually paid us through the system. So we know who's contributed what and when and for what project. We've got their capital stack. So for me to go ahead and run a distribution live, that process will look like this. I'm going to go ahead and make a new distribution. Again, we saw some of this a moment ago, but I'm going to go into a little more detail here. And we're going to go ahead and allow Coversea to actually make this distribution payment to our investors. We're going to see some numbers here, and I'm going to run through this fairly quickly so we can get an idea of how fast we can execute a distribution. But like I said, we're going to go ahead and back up into some of these calculations. So for my purposes, I'll go ahead and calculate a waterfall. I'll make a $300,000 distribution payment and calculate on that. For my waterfall, we're going to see that each of my investors have part pref, and then the rest, at least at this point, is going to be return of capital. Maybe at a later stage, I fulfilled that return of capital obligation, and I might hit some later catch-up hurdles. But for today, I've got a preferred return. I've got a return of capital. If I want to make any adjustments live, I can do that. But if I'm good to go, I'm ready to make the payment. We'll see that we've got all their bank account information already integrated. Before I make this payment, as we saw before, I'm going to go ahead and download these calculations, which we will dig into in a moment. This is actually a really critical piece of our system. But real time, we can imagine we've plugged in our number. We see the calculations. I'm going to go ahead and create this distribution. And our job is pretty much done. I'm going to go ahead and finalize this distribution and get ready to make the payout. As soon as I finalize this, every investor is going to receive an email breaking down the distribution. We're going to see we're paying out this much money for this asset, for this fund, potentially, to this bank account. I will finalize this. And what we'll see here is that, if I can respond to my two-step here, at the very least, for security reasons, we're going to have a two-step. Some of our groups actually prefer that maybe somebody on the accounting team starts this, and then we have an approval account that has signatory powers. But either way, I'm going to confirm this, and then we're done. So at this point, all of our investors have received that notification email. We've made the payment, which is, of course, the most important part at this stage. And if we were to look at our investor portal, we would have seen that all the reporting that should flow out of this distribution, all the updating of cash flows, all the metric calculations, building a transaction history for our investors to see, all that is done live. So my job is done. So from the point of view of just being fast, we'll do a pretty good job here of making it so that it's not something that you have to scramble to accomplish. But then we might wonder, okay, we can see that we have this number here, but how did we actually get here? How do we confirm this is true? And so this brings us really to that download we did earlier. There are plenty of systems out there that will attempt to calculate a waterfall for you, but it's just as important that we know that the calculations are accurate, that we can actually show our work as it is to actually produce this number, because we don't want it to be something where maybe you use us to send the payment, but you still have to have an Excel off to the side that you're constantly running calculations on to cross-check. So where this download comes in, if I pull that up for myself here, is we're going to go ahead and break down for this distribution exactly what happened. So immediately what we're going to see is a really high-level overview of the state of this distribution. And we can go through this, but where it becomes really interesting is that on an individual investor basis, we're going to break down exactly what happened here. So we're going to see all of the current distribution information laid out for us here. If there are any accruals we should be taking into account, we're going to see those accruals laid out for us here. We're going to break down the transaction history that led up to this distribution, which again has to do with those accruals. And then the hurdles that we described earlier, we're going to lay those out for us here. So I said before, for my distribution, I have a return of capital, or excuse me, I've got a preferred return component, and then a return of capital. Once I meet my return of capital obligation, at that point, I might fall into some of these other hurdles. But at this point, we can see the payout here, and we're actually, this is what we're looking at here are the raw calculations. So whatever the correct formula would be for your specific waterfall, we're going to lay out those raw calculations for you here. We're going to take into account any withholdings and adjustments. And the end goal of a system like this is we want there to be no question how we got down to this final number. So for your own record keeping, this is critically important. Just as important as actually making the payment is making sure that you have this this file that you can refer back to at a later point in time. But also, because we're breaking this down on the individual level, and actually every investor in this waterfall, really, we could have our own, they could have their own separate waterfall structure for each of them within any given deal. If Janice has a question, okay, how did we get down to this number? We can even pop out this tab and send it to her as her own worksheet. So having a system like this, in addition to actually being able to make the payment, very important. If you're a fund advisor even, or maybe just somebody that does any sort of annual auditing, you want to make sure that you have this kind of proof of work. And that should give you a pretty good idea of how Cover C will handle a system like this. I think we'd be happy to, at a later point in time, if anybody has any questions, go through other potential waterfall structures in an Excel format like this. I'm sure there'll be questions after this call, so I guess we can wait and see who has those questions. But I'm going to go ahead and pass it back to Tara, and we can wrap this up. But please plug in your questions. Happy to go through anything while we're on this call, as long as we have time. And then if we don't get into any questions now, we can always come back to those later. But Tara, I'll pass it to you.
Okay, Carl, can you share your screen? Thanks, everybody. We got a couple questions while we were going, so we'll ask those. I know we're almost at time's up, so happy if you guys can stay a few more minutes to hear questions. Colin, well, I think this would be a good one for you. What if I have different terms for different investors within the same deal? I have an anchor investor in the deal who negotiated us to remove any catch-up hurdles. How will that impact my waterfall?
Yeah, I muted myself. So that's a good question. That actually does get back to what I was just speaking about a moment ago, which is the fact that we because our engine really is running off Excel in the background, we can really accommodate any possible structure. Oftentimes we do see that we may have multiple different variations on a waterfall within a given deal. So we saw earlier, Janice has a pref and then a return of capital. Another investor in that same deal might have a completely different set of hurdles, or maybe just a variation on the pref, and they might have a different split structure after the fact. But because we have this Excel engine running in the background, we can be just as customizable as Excel can be. So any variations, not only deal by deal, but within a given deal, we can accommodate, we can plug that into the platform, and we can run off that forever.
Cool. There's another question too, Colin. I think this would be good for you as well. Um, so per our operating agreements, we accrue pref on a daily basis, not a monthly basis. We checked with another provider and they couldn't support this. It would result in the LP's amount being slightly different than our deal spreadsheet actually shows. Is this something that CoverC can support, the daily, not monthly pref accrual?
Actually, I'm fairly certain that that this might have been one of the pitfalls that we discussed earlier. Yeah, or maybe it related to that, but yes. So if you're accruing on a daily as opposed to a monthly basis, that's just a change in the formula. Again, it gets back to that Excel engine. All we have to do is agree on the specific calculations that are right for your deal. We plug that into our system and we can run on it. So we can be as customizable as we need to be. If it accrues on a daily basis as opposed to a monthly basis, it's no problem. We just build that into the spreadsheet, plug it in, and we go. So yeah, no issues there.
Okay. Colin, also you were talking about this as you were discussing different things, but can you go back and kind of give us a definition of what a catch-up is?
What a catch-up is. So yeah, catch-up really just describes usually at some point after the pref, maybe even after return of capital. It's the point at which now the GP starts to the GP starts to uh, uh, take some of those gains, usually as a reward for their performance, whether it is just a typical catch up. So maybe it's a 8% pref, and then afterwards the GP gets 20% as part of an 80-20 split, or maybe there's a semi catch up where the GP is getting a 50% split at a certain hurdle level. Maybe that's the fourth hurdle in a set of hurdles. Just describes the point at which the GP starts to take their profits due to their good performance. So that's a good thing for sure.
Yeah, the GPs definitely deserve to get their cut, right?
I think they do.
Yeah, so can you tell us about so like this was awesome to see everything that's happening, and can you share with us what the investor sees, like how, like you said they would get an email, but is there another, like how else do they experience like what they're receiving and all that kind of stuff?
Sure. I referenced before the portal, which I could even show here if we've got time for it. In the investor portal, do you think I should share my screen? I can share my screen here, and we can walk through this just super briefly.
Yeah, I think that's a good
I don't
idea.
want to take too much time on it, but I referenced before that yeah, we would obviously want to notify the investors via email. We want to make the payment, but just as important, we want to show them live where they are in a deal, what their performance looks like, what their cash flow looks like. So we're looking at an example of an investor portal now where I could see on a super high level across all my deals, my cash flows, my distributions, my profits. But within any given deal, as soon as we click that button, we make that distribution, what we're going to see, ignoring some of the project level and details here, we're going to see that all of our cash flow adjusts instantly. And again, this is what the investor sees when they're looking at a project they're invested in with the GP. My cash flow updates, all my position information updates. Maybe it is year 3, we've done a refi, there's a return of capital. I'll see there's capital returns here instantly. See there's a deduction to my capital account. If we're calculating on any metrics, we'll see those metrics adjust live. And I think just as important, if we look at our transactions, which you want to see as the GP, but also the investor wants to see, not just distributions, but also contributions. I pay you, but for our purposes, for this conversations, any distribution will be here live. So you click that button, 2 seconds later, I'll see a distribution has appeared in my transaction list. If I dig in here, because we're calculating the waterfalls, I'll see that there's a breakdown across the different hurdles in this deal. So I'll see there's a preferred return piece, catch up, like we discussed, a return of capital. And so just like we want to make the payment piece easy, we don't want it to be something where you have to then go ahead and plug all that information into our system after the fact. It should at this point just flow. You click the button, the payment flows out, the notifications go out, the portal updates itself, and this should provide just a better experience for everybody.
Well, I want to thank everybody for attending this. Everyone got to stay extra long, so that's really good. Thank you for joining us today. There are just a couple questions we didn't get to yet, so we'll get back to you individually. And then, as we've seen throughout this webinar, deal structures can be super complicated, and we would love to challenge you to ask us to build a customizable waterfall distribution. And if we can't build it, we believe that we could, but if we can't, we'll give you 50% off a pro package until we can bring it together and build it. So I want to thank everybody for your attendance and your great questions. And thanks, Skull and Colin, for your great information that you shared with everybody.
Absolutely. And Tara, can I ask, just because we had a question earlier, when do we think that we'd be able to send this recording out, just so people can know to expect it?
We can send it out today.
Okay.
I can download the content later. Yep. So we'll send it out to everybody who attended. And it'll also be on our website too, if you want to see it later. So thanks, everybody. Bye-bye.
Thanks, everybody.
Thank you, everyone.